Hello all of you, I hope you all are doing good. So today we are to do the revision of accounting standard 20, that is earning per share. So there are so many things that we are going to discuss here. Very simple accounting standard, you don't have to worry. So we will discuss about the first introduction, then applicability, then certain definition, what is equity share, preference share, potential equity share, then presentation, basic EPS, the date from which equity share are included in weighted average, then change in number of share without change in resources, bonus issue, bonus element in right issue, diluted EPS, then the convertible preference shares, then here convertible debenture, option or warrant, and calculation in diluted EPS in case of multiple potential equity share, and lastly the disclosure. What is this? First of all, EPS. Now understand this one. This is your profit and loss account. So in my profit and loss account, in everyone in their profit and loss account, they write it down their income and expenses. So when I say they write it down their income and expense, the profit comes at it. But as a user of financial statement, we want to see that how much basically this profit belongs to one share. I'm going to say the portion, whatever the profit that we have here, how much is portion of that profit belongs to one equity share. We call it EPS. Obviously, there's some way of doing the calculation of it. We'll discuss in detail that. But there are two types of EPS, so we'll discuss both of them. There are two types of EPS. That is a basic EPS. Okay, basic EPS, and there's a diluted EPS. So there are two types of EPS, basic and diluted EPS. We'll discuss both of them. Okay. Now, what it says that here now, just give me a minute. Okay, what it says that now, they say it describes the principle for determination and presentation, that how to determine, how to do the calculation of EPS that here, and how to present it. So should we present them in a notes to account? No. In P&L account, but P&L account obviously in the account, we just write it down that here, how much is the earning per share. How to calculate, we'll discuss it that here. But we present in P&L account. Obviously it does not count the total of income and expense that here. No. That is a different thing. Income, expense, profit, that is different. Below that, we write it down EPS in profit and loss account only. So this AS20 talks about how to determine and how to present them. Then it's to improve the comparability of performance among different enterprises and accounting periods. Obviously, when we calculate the EPS, if EPS is increasing, it's a good sign that. It's a good sign that here. Okay. So we can do the comparison within the industry only. For example, Jio is doing the comparison with Airtel. Okay. Now, AS20 provides the methodology for computing the basic and diluted EPS. Yes, there are two types of EPS that we'll discuss it, basic EPS and diluted EPS. And accounting standard 20 talks about that, how to calculate the basic and the diluted EPS. Now, when we talk about the applicability, AS20 is mandatory for all companies, but they say there are certain exemptions. The small and medium companies are exempt from disclosing diluted EPS. So there are two types of EPS, basic and diluted. But for the small medium companies, the AS20 is, not AS20, the basic, this diluted EPS is exempt. So no need to disclose the diluted EPS in case of SMC. While encouraging, it is encouraging that it is not mandatory, but recommend, even though it's a small company, recommend to disclose both. That is the basic and the diluted EPS. But when we talk about a consolidated financial statement, what happens in case of their consolidated financial statement? We are to merge the financial statement of subsidiary and the holding company. So what it says that here, when we consolidate the financial statement, obviously my figures is going to change. We are going to merge it, and it's a profit of both the holding and subsidiary company. So we have to calculate EPS on the basis of that consolidated financial statement, because we are going to take certain figures from the consolidated financial. When we calculate the EPS, we are going to take the figures from that financial statement. Okay, like we have to take the figure of profit. So when we prepare consolidated financial statement, we are going to take the profit of holding and subsidiary. No problem, take that profit. Okay. Now definition, very simple. What is equity shares? Any shares other than the preference share. So what do we mean by preference share? So preference share basically have the preference in two things. First, we give dividend first to them, and then at the time of liquidation of a company, we give first, do the repayment of the preference shareholder. Okay. Now, the interesting part is that, but timing, just understand what do you mean by potential equity share. Okay. What do you mean by potential? But there is some use of the potential equity share when we discuss about the diluted EPS. But what is this potential equity share? They are not today equity shares, but they are going to be converted in future into equity share. We call them potential equity share. For example, convertible debenture, convertible preference share. They are not equity shares today, but they are going to be converted into equity shares in future, like the options, okay, share application, money, they will receive that. But they are not basically today equity share, but they are going to be converted into equity shares in future. We call them potential equity shares. So it means why there is a need of these potential equity shares here? Because we will discuss about the diluted EPS where there is a use of the potential equity share. I will discuss there. But this accounting standard talks about the presentation and determination. Determination is how to calculate, and how presentation is how to present. first discuss how to present this EPS and diluted EPS. First of all, these EPS and diluted EPS we are going to disclose in profit and loss account, not in notes to account. Then any negative basic and diluted EPS should also be presented. What is negative? If you have a loss, so EPS is not going to come positive, EPS is going to come what? Negative. If it is negative EPS, then we have to calculate here. Okay, negative, positive, whatever is that here. So we cannot give the excuse, no, we have a loss during the year, so we will not show because we don't have earning. It's a negative figure, okay? It's a loss per share, okay? So still we have to disclose them as a negative figure. And they say basic and diluted EPS should be equal prominence in the presentation. When we do the presentation that in profit and loss account, basic and diluted, we have to give them equal prominence. What is equal prominence? Equal importance to both of them. We have to give the equal importance to both of them, like the font size and all the, we cannot show that size and the font size, you can say the color, you can say that here, okay? Everything should be a equal prominence. Same for the diluted and the basic EPS. We cannot bifurcate that differently we are presenting them. No. Whatever that here, we have to disclose them. We have to give them the equal prominence. Now we are coming to the main part, that is how to calculate the basic EPS. As we know that there are two types of EPS, basic and diluted. First, I am discussing with you how to calculate basic EPS. So what's the formula of basic EPS? So they say that here now. Basic EPS, when we calculate, it's net profit attributable to equity shareholder divided by weighted average number of shares. So one by one, first we'll discuss what do you mean by net profit which is attributable to equity shareholder. They are talking about that profit which is only for equity shareholder. So you can see that here, earning before interest and tax. This, then we deduct what? Interest expenses on loan, debentures, bonds, etc. Then we have earning before tax. Then we deduct the tax. Then we have earning after tax. And then we have to deduct the dividend as well, that is to the preference dividend. Because we are talking about what is the, first of all, this EPS we calculate for equity shareholder. Earning per share. What is share? Equity shares. We are not talking the preference share. So we have to deduct all the item up to that stage, and whatever belongs remaining, it should be for the equity shareholder. So that's why we have to deduct the preference dividend also that year. And here if it is positive, that's a net profit. If it is negative, it's a loss. But one important thing is that here, this is we have, when we talk about this profit which is attributable to equity shareholder, we have to deduct all the expenses that year, okay, including the preference dividend. Like the tax expense, next year I will take that only that year, AS22. The current tax and the deferred tax, you have to deduct exceptional item as per AS5, extraordinary item as per AS5, change in accounting estimate, change in accounting policy, each and everything we have to take when we talk about what is the profit. Every item we have to take in a P&L account. But when it's come to the preference dividend, remember there are two types of preference share, cumulative and the non-cumulative. In case of a non-cumulative, we are going to write it on preference dividend only if it is provided in the books. But in case of a cumulative preference share, even though irrespective whether or not the dividend have been provided for in the books, whether they have recorded or not, it doesn't matter. In case of a cumulative preference share, we have to deduct the preference dividend in case of a cumulative preference share, even though it is not provided in the books, because we want to profit which is attributable to the equity shareholder. So non-cumulative means the dividend is not going to be a carry forward. But in case of cumulative, we know that here, even though it is not recorded, we have to pay in the next year. So what is going to happen now here? Cumulative preference shares, even though it is not provided in the book, still we have to write it down to find it out how much of the profit belongs to the equity shareholder. Now, one more point is that now if we have a more than one class of equity shares that year, so what it says that in case of a more than one class of equity share, what do we mean by more than one class of equity share? Means, for example, if I say that now there are two type of equity share, to one we give one vote equals to one vote equal one, or we can say that we have one share, one vote. But the other type of equity share, they don't want to do the voting that, but we will additional dividend. So basically one class of equity share that we have. So how to distribute the profit, how to calculate the EPS? So they get allocating the different class based on their dividends that year. So we are going to allocate the profit, whatever profit between the different class of equity share on the basis of rights of their dividend. Let's take an example that here now. If I say this is not so important from the examination, but still, okay. Now what happened? There are two type of that A and B. Okay, there are two type of equity shares, A and B. Okay. Now A has 3,000 shares and B category class based 2,000 shares. But B has a more 50% dividend that they have here. Okay, so to allocate the profit, total profit which is given in question, that is 1,40,000. 1,40,000. I have to allocate this. Okay, between class A and B. So how to allocate it? How to allocate that here? So A has first of all only 3,000 shares and B has 2,000 shares, but they have the more rights. So plus 50% dividend we give them. So equivalent shares is going to come 3,000 shares here only. Okay. So I'm not saying when we calculate EPS, we are going to consider 3,000, but for the purpose of allocation of profit. So we have a profit of 1,40,000. So we will distribute in the ratio of 3:3. That will come 70,000 and 70,000. And you can see that 70 divided by 3,000 and 2,000. Because when you calculate the EPS, I will take the actual number of shares. But when we talk about allocation of the profit, on that we have to distribute on the basis of their rights on their dividend that here. Okay. So they have the 50% more dividend, they get that here. So we are distributing a share profit on the basis of their number of shares. So to make it that proportion, we increase the number of shares on the basis of their dividend rights that year. We can distribute the profit of 1,40,000 in the proportion of 3:3. That is 70 that year. You got the point? And then number of 70,000 70 divided by number of shares 3,000, and here it is what? The 2,000. Like that we calculate. Okay. Now I'm coming to a point that now first we discuss about what is this equity amount, the profit which is attributable, earning which is attributable equity shareholder. Okay. But what is the formula that? The formula is that is the net profit attributable to equity shareholder divided by weighted average number of shares. What is this weighted average? Because they don't want to tell you that here to take the number of shares at the end of the year. No. They say we have to see how much is at the starting of the year, and whenever we issue or whenever we redeem, whatever is that, proportionately we have to calculate. What does it mean? Understand? Equity shares are adjusted by time factor and paid up value. So number of equity shares outstanding at the beginning of the year, number multiplied by the paid up value divided by face value. If suppose the share is of ₹10, they paid 10, then no problem. But if they paid 5 out of 10, so that proportionally shares will also get reduced here. So formula is number of equity shares outstanding at the beginning of the year multiplied by paid up value divided by face value. Then you issue certain shares during the year. The number of equity shares issued during the year divided by number of months. Suppose you issue in the month of July. So July 9 months, July to March, 9 months. So 9 divided by 12. And how much is the paid up value divided by face value? Okay, if you have done the buyback. So same formula, number of equity share bought back during the divided by number of months. Suppose you on 1st of January, so 3 months, January, February, March. Okay, multiply by that 3 divided by 12. Okay, you have to deduct because we have done the buyback here. So whatever shares come, we call them weighted average number of shares. So point A divided by B. What is A? Profit attributable to equity shareholder divided by weighted average number of shares that year. Okay. Now, when we talk about it to count the, I'm going to say this number of shares from which date, because when certain shares we issue during the year, certain time we do the buyback. From which date, if you issue certain shares during the year, from which date we have to count it that year. So it might become in the theory that year for 4 marks that year. So you can see that the date from which these shares are included in the weighted average. First, now equity share in exchange for cash. So when cash is receivable, equity share issued as a result of conversion of debt into equity. The debt is converting into equity on the date of the, as of the date of what conversion, on the date those debt is converted into a shares. From that date we will count it. Now equity share issued in lieu of interest or principal on other financial instrument that year. So as of the date the interest ceased to accrue that year. Okay, we issue the equity share on in case of what here, the interest or principal some financial instrument that year. So they say as of the date ceased, means interest is not going to charge. From that date it will be considered the date of conversion. Now equity share issued in exchange of settlement of liability of the enterprise. As of the date settlement becomes what here? The effective that is. So certain liability we are liable to pay. We say no, listen, cancel this liability, I will give you the issue. So I will give you the shares. So the date on which basically the settlements become effective, that will be considered a date of issue of shares. Then we have equity share issued as consideration for acquisition of asset other than what? The cash shares. So what happened? Equity share issued as consideration for acquisition of assets. I will give you, I am giving you shares, but in return I am taking the asset from you. For example, fixed asset. Okay. So as of the date, as of the date on which the acquisition is recognized, the date on which you recognize that asset in your books of account. The equity share issued for rendering of services. It means I will give you shares, in return you give me some services. Okay, like the consultancy service, the auditing service. Okay, as the date on which the services are rendered. Okay. Now equity share issued as part of consideration in an amalgamation nature of purchase. So you know that the amalgamation chapter. So there are two types of amalgamation nature of purchase, amalgamation nature of merger. So when it's come to amalgamation nature of purchase, we have to issue the share. But from which date the purchasing company issue the share? But from which date it will be considered? Date as on the date of what? Acquisition. Now equity share issued during the reporting period as a part of consideration is an amalgamation nature of merger. So what happened in case of amalgamation nature of merger? If it is, we issue the shares here also. But that will be considered, we have issued the share at the starting of the reporting period. Why at the starting of the reporting period? The reason is that here now, because financial statement treat the combined entity as it existed from the beginning of the reporting period. We know that here, in case of amalgamation nature of merger, we take all the assets and liability of the vendor company at the book value, reserves also we take. It's like a merger on. It's like a same company. That's why they say in case of amalgamation nature of merger, we have to take from the reporting period that year. Okay. Then they say that here now, contingently issuable equity share means it depend on satisfaction of certain condition that we say if the sales is that much, then we'll give you. Okay, like that. So from the date on which the necessary condition under the contract have been satisfied. So you achieve that target suppose. So it is now we are going to issue the shares. So it depends on some contingencies, some event that year. If that events happen, then we have to, from that it will consider as the shares have been issued. Okay. Now, understand this one. I am not yet come to the diluted EPS that, but just give me a minute. Can we take certain questions here? Bonus. Okay. Now, let me do, okay. Now, let's carefully. Now, what happened is that we know about how to calculate basic EPS. That is the net profit which is attributable to equity shareholder divided by weighted average number of shares. We'll see certain question on it. Don't worry for that. Okay. But certain time what happened that there are certain type of shares that we issued. Okay. That we issued that year. But what happened without change in resources? We are not going to receive the amount. Say what? Yes. Like the bonus issue. So when I say the bonus issue, okay, and one more is bonus issue in right issue. What is right issue? I will discuss you later. But first focus here. When I issue a bonus share, what happened? Number of shares is going to increase. Come on, don't you think so? When you issue bonus share, what is bonus shares, beta? We are issuing the shares free of cost. What we are doing that? We are issuing the shares free of cost. So when I say that here, when we issue the shares that here, we are issuing the shares free of cost. So, but we are not going to receive the amount, correct? Yes. So there is one problem that here. Now they say in case of a bonus issue that here, they say how to calculate. What it say first? Bonus issue means the shares are issued to existing shareholder free of cost. The weighted average number of equity shares should be counted from the beginning of the period and adjusted for all the period presented, but bonus issue date is irrelevant, which is very important that here. What they're telling us that now, when it's come to the bonus issue, they say from which date should I count the bonus issue in case of a bonus share? They say count it from the current, from the starting of the date. For example, that here now, for example, suppose they are following the calendar year 2026. We issue the bonus shares. So suppose we issue the bonus shares, we have whatever number of shares we have, we issue the bonus shares also. We issue on suppose 1st of July 2026. But for the purpose of bonus, it is going to count from 1st of January 2026, that is from these date here. So they say here, it should be bonus issue date is irrelevant. They should be count from the beginning that year. Okay. Now, they say we also have to restate of the previous year. So previous year also that whatever number of shares that we have to add the bonus shares here also. Now people say, why sir? Because we issue the bonus share on these date on 1st of July. And you are telling us we issue the bonus shares on 1st of July. And you are telling us that here when we talk of the 1st of July 2026 that year. But you are asking us to when we calculate the EPS, so from which date we issue the bonus share, you ask, AS20 says us to count it from the starting of the period. Suppose the starting of the period of 1st of January to count it from the 1st of January for the whole 12 months. At the same time, they say when you calculate EPS, we already calculate EPS of the last year. Yes. But they say restated. Restated means recalculate that year. Recalculate that year, the EPS of the last year and add the bonus share in that. But why? Why? Now understand the logic. Because in case of a bonus share, we don't receive the amount. Basically, we pass the entry reserve and surplus account to share capital account. So we increase the share capital. We increase the share capital, but we reduce the here reserve and surplus. That we can do anytime. We just reduce the profit that here. We can do anytime. So they say even in whatever date you do that here, but that you can do with the previous year also that year. So they say for the purpose of comparison, it is proper to recalculate everything that year. Otherwise, people might do the manipulation. Bonus shares I can issue anytime that year. So on the basis of my requirement to fluctuate the EPS, I will decide the date. They say no. Do whatever you want to do, whatever date you want to do the issue, the bonus share, do that. But what is more important is that you have to count it from the starting. In fact, you have to recalculate the previous year EPS also that year. Okay, and consider the bonus share there also. Okay. Now let's take a question on that. This is what they say that following basic EPS are calculated in case of bonus issue. Original EPS of the previous year we already calculated last year. Now before the bonus issue, obviously. Now we have to mention after the bonus issue what is the effect, and we have to calculate basic EPS of the current year after taking into consideration what the bonus share. I'm going to say we issue the bonus share during the current year. So calculate by considering that, and last year original EPS we already calculated last year. But again, we have to calculate by considering the bonus share in the last year's shares also. Okay. The bonus share is considered by adding the bonus share to the weighted average number of shares. Date is irrelevant. Okay. Now, come to super 100 question. Now, come to question number 65. It says the net profit for the year 20x1 is 18 lakh. So, last year profit, 20x1. We have a net profit there, 20 lakhs. Okay. Oh, no, sorry, 18 lakh. 18 lakh. Now, we have net profit for 20x2. That is coming on 60 lakh. So, net profit here, I have 60 lakh. Okay. Then it says that the number of equity shares outstanding until 30th of September 20x2, 20 lakh was the share. The bonus issue on 1st of October 20x2, 2 equity share for each. For one share, they are issuing to 2. So already existed how much? 20 lakhs. Plus we issue bonus share, but date is irrelevant. Okay, date is irrelevant. 1st October, it is irrelevant for me. Okay, they are for the calendar year. Okay, so how many shares? For every one share they issue 2. So we have 20 lakh shares. So on 20 lakh, how many shares we are bonus share? We are issuing 40 lakhs. For every one share they are issuing 2. What will be the EPS here? So 60 lakhs divided by 60 lakhs. So EPS is going to come here 1 EPS. The last year also we have to recalculate. Okay, so 20 lakhs was the shares, but we issue the bonus shares 40 lakhs. We have to consider and recalculate it. So 18 lakh divided by 60 lakhs. That's coming a 0.3. Done. 6 marks is your 0.3 and 1. So you can see that a 1 here is coming and here it is coming 0.3. Okay. Now understand the next concept. What happened? There is one more thing that here now, which is all. Just remember these steps that here. There is one more thing that in that what happened that here, there is a bonus element. We issue the share, but there is certain bonus element in that. You know what is right issue? The right issue we offer to existing shareholder at a lower price. What I'm saying that here, right issue we offer to existing shareholder at a lower price that here. What does it mean at a lower price that here? So I will, instead of offering to the outsider, I will say you're already my shareholder. So to make it simple, I will offer to you first. This is what the company that also says that. Okay. So when I will offer to you that here, I am offering you less than the market value. Suppose the market value is 20, I am offering this for example 15. So there is a bonus element that here. Okay, there is a bonus element because I am offering you lower cost that here. But how to find out? Not a complete share is not on the bonus element that is. There is a certain portion where I am offering a lower amount. A certain portion is the bonus element. So remember the 3 steps when it's come to the right issue. Okay, how to calculate? Step number 1, we have to calculate theoretical X right value. What is X right value? How to calculate that here now? They say fair value of all outstanding share immediately prior to the exercise of right. So they say what is the fair value is the market value of all the outstanding share before the right issue, plus the total amount received from the exercise of the right issue. Okay, divided by total number of shares, total number of outstanding prior to the exercise of the shares plus number of shares issued. Now understand whatever step by step. Let me tell you that here. Go to that here now, super 100. Now this question number 66. They say net profit for the 2021 is how much? 11 lakh, and net profit for the year 22, that is a 15 lakh. So this 2021, 2022. Okay, now understand this. Now they have a net profit that here in 2022, that is 15 lakhs. Okay, 15 lakhs that there. Number of shares outstanding to the right issue, we are offering how much? 5 lakh shares. We are offering at what price? 15 rupees. Last date of exercise is 1st of March. Okay. Right issue on 1 new share for each 5 outstanding. It means for 5 we are offering them 1 share. So they have 5 lakh shares. We are offering them how much? 1 lakh shares. Okay. So fair value of 1 equity share immediately prior to the exercise of right issue on 1st of March 22 was rupees 21. So what is the fair value? Is 21. We are offering them at what? 15. Now understand one by one. Step number 1. Step number 1. So what it says that here now, step number 1, they say fair value of all the outstanding share immediately prior to the exercise of the right. So before the right issue, how many shares were outstanding? 5 lakhs. So let me write it down here. 5 lakhs multiply by what is the fair value? 21 plus how many shares we issued on right issue? 1 lakh multiply by, okay, what it says, the total amount received from exercise of right issue. So 1 lakh multiply by, we are offering at what price? 15 divided by how many shares that we have? 5 lakh divided by 5 lakh, and this is 1 lakh that is. Okay, so 5 lakh plus 1 lakh total number of shares. So here it is coming 5 lakh multiplied by 21 plus here 15 lakh divided by 6 lakh. That is coming how much? Rupees 20. So X right value is coming 20. Okay. Now step number 2. This is step number 2 that now. How much is the bonus element? So the formula is that here now. The fair value of the share price to exercise the right divided theoretical X right value. So what is here if I say that here now? How much is the theoretical X right value come? Rupees 20. At what price? What is the fair value? Fair value is 21. So it means the market value before the right issue was how much beta? 21. But at what is the market value of theoretical X right value means, so what is the market value after the right issue? So market value before the right issue it was 21 and the market value after the right issue is 20. So there is a bonus element. It was 21, now it is 20. That is coming 1.05. We call them adjusting factor. Okay. Now step number 3. What it says then in step number 3? It says that here now here is the basic EPS we calculate, net profit attributable to equity shareholder. The net profit which is attributable to equity shareholder which is given for the current is 15 lakh. 15 lakh divided by, then they say that here now divided by that here weighted average number of shares. So you will tell me, sir, the number of shares that we have, the 5 lakh initially it was and we issue 1 lakh. So when I say the 5 lakh initially it was, so 5 lakh it was. Now here we issue 1 lakh. So how much share that we have? Now we have 6 lakhs, 5 plus 1. But understand this. So 5 lakh it was that year. Okay, 5 lakh it was. Now we issue 1 more lakh that year. So total we have, it comes how much? 6 lakhs that year now. But now just give me a minute. Okay, so 5 lakh multiply by, how much is the 5 lakh? That's it, say the multiply by that here now. How much is the 5 lakh multiply? When we issue the right issue, we issue the right issue on 1st of March. So okay, the January, February. Okay, so after 2 months, they are following the calendar year. So 5 lakh shares were outstanding. 2 by 12. Why 2 by 12? Because they issue on what is the last 1st of March, January, February. But this is interesting that here now here it will come 10 by 12. Correct? 10 by 12. For the 10 month, this is for the 2 month. The interesting part will come now. They say that here now, for periods before the right issue while calculating basic EPS, that is number of equity share before. Understand? Before the right issue multiply by the adjusting factor. So we issue the right issue here now. I mean it's the 1st of March. Before the 1st of March, how many shares were outstanding? 5 lakh. So multiply by these adjusting factor here to these 1.05. So it will come that now 15 lakhs divided by 5 lakhs multiplied by 2 divided by 12 multiplied by 1.05. That is coming 87,500 shares plus here 6 lakh multiplied by 10 divided by 12. That is coming 5 lakh. So EPS is going to come 15 lakh divided by 5 lakh, 87,500. That is coming 2.55. Cross check it. 2.5555. Yes, 2.55. Okay, this is how we calculate. So just remember these 3 steps. They also tell us to calculate the previous year also. The previous year original and restate. So original was how much that year? Previous year profit was here, the 11 lakh, and the number of shares were outstanding 5 lakh. It was the original. So 11 lakh was the profit. 11 lakh was the profit divided by 5 lakhs number of shares. So how much it will come? That is coming 2.2. 2.2. Now I restate that here. So again, that how much is the profit for the last year? 11 lakh divided by 5 lakh number of shares multiply by with the for the whole year 12 by 12 multiply by for these adjustment factor 1.05. How much it is coming that now? 5 lakh multiplied by 1.05, that is 5 lakh 25,000. So 11 lakh divided by 5 lakh 25,000, that is coming 2.09. So how much it is coming? 2.09 or 010. Okay, done. So this is how we calculate that. This is how we calculate. Okay, in case of a right issue. So these are the 3 steps that we have to follow for the current year. And previous year we have to also do the restate, and we have to multiply. This is important. Just we have to multiply with the adjusting factor of all the shares that were issued that were outstanding before the right issue. So we made a right issue here. So we have to multiply it with the discount adjustment factor. Okay. Like in case of a bonus share, core bonus share, what we do that here? We will multiply the bonus. We will consider the bonus share even before the issue of the date of issue that year. Like the previous year we consider this bonus shares. Okay. We have to count it from the starting. But in case of a right issue, there is a bonus element, but not complete bonus element, that we have to calculate how much is the element of the bonus. So we call it adjustment factor. So this is how we calculate adjustment factor. This is the formula that there. It might come for the 7 marks, and they are instead of ask for the 7 marks. You just have to follow these steps that here. Okay, these steps. Now I'm coming to again these repetitions that here. Now what happened that now they say here is the diluted EPS. So what is diluted EPS that here? Now first of all you have to now the main, I will tell you what are the steps and all that. Through this it will be easy for you to understand that here. But listen me carefully that here. What it says that here, first of all, what do you mean by potential equity shares? Potential equity shares mean they are not equity shares today. I'm repeating it that. Are they equity shares today? No, they are not equity shares today, but they are going to be converted into equity shares in future. I'm repeating it. They are not equity shares today, but they are going to be converted into equity shares in future. So hypothetically, we say if they convert into equity shares today, what would be the EPS? So what would be the EPS? If I say that here now, if my basic EPS is, suppose if I say 1, and if those potential equity shares, if hypothetically, if they converted into equity shares today, what would be the position? So if that is coming 0.75, it is diluting. Basic EPS is 1. If they converted today, so then the EPS would be 0.75. It's a diluted because it is reducing from 1 to 0.75. Okay. If they're 1 and if they convert it today, then that is coming 1.50. It is anti-diluted. So this is diluted. This is diluted. And this is anti-diluted. You got the point? One is diluted and one is what? The anti-diluted that is. You got the point that here now? So one is diluted and one is what? The anti-diluted here. Okay. So we have how to calculate obviously diluted EPS. I will tell you that here. But if it is anti-diluted, then we don't I'm going to say that present them. We just have to mention diluted. Because when they will convert it that year, then my EPS will go down. So if they convert today, so my EPS will be lower than the basic EPS. So we have to disclose that also. But how to calculate this diluted EPS? This we did disclose, anti-diluted we don't disclose. So how we calculate? They say earning attributable to equity shareholder using the basic EPS. Whatever the profit that we have find it out in case of a basic EPS plus increase due to the potential equity share. So if they convert today, so two things is going to happen to understand. If they convert today, for example, preference, if dividend converted into equity shares today, so it is going to affect my profit. How? I don't have to give the preference dividend, so my profit will increase. But at the same time, number of shares will also increase because they converted into equity share. If convertible debenture converted into equity shares, so what happened? I don't have to give the interest to the debenture holder, so my profit will increase. But at the same time, I don't have to pay. I have to pay the tax because the profit is low. So accordingly, my profit will fluctuate. But at the same time, what is going to happen? Number of shares will also increase because if they convert today that year debenture into equity, number of shares will also increase. So what is going to happen in that case? What they say is that here now, when they say we have to calculate that here now is what would be the adjusted profit and adjusted weighted average number of shares. What is the impact on profit and shares in these cases? So what it says that now here, if that here now diluted EPS, if diluted EPS is less than the basic EPS. So what is the diluted EPS? Suppose 0.75. And the basic EPS is 1, it is a diluted EPS is reported. If my diluted EPS is more than 1, so more than basic EPS, I mean to say, suppose the basic EPS is 1 and that this is coming 1.5, it is anti-diluted we call them, and diluted EPS is not reported. In that case here, these I mean to say anti-diluted, this is not reported. It is more than 1, we don't disclose it. Okay. Now, what it says that here, let's see that here. Suppose a convertible preferential. How it will affect my numerator, means my profit. I don't have to give the dividend, so I have to add this. But how it is going to affect my denominator, number of shares? So my equity share is increase because we convert the preference into equity. Number of shares will increase. In case of debentures, I don't have to pay in case of debenture, if converted into equity share, we don't have to pay the interest that here now. So my profit will increase, but obviously we have to pay the tax. The profit will decrease there. So you can take the net effect. number of shares will increase. Now, share option and share warrant is something else. I will explain what is it through an example. Through this example, I will explain it. Okay. Now, we will come to share option and diluted that, but come to super 100 question and come to question number 60. I will cover 67 later on, but first come to question number 68. Okay. Now understand. They have a net profit for the current year is how much? 1 crore. They have a number of equity shares, that is the 50 lakhs. So basic EPS will come to correct. If I calculate basic EPS, that is 1 crore divided by 50 lakhs number of shares. That is going to come 2. So basic EPS is coming how much? 2. Now when I talk about the diluted EPS, so how much profit we consider there? 1 crore, sorry. And how many number of shares? It was 5 lakh. No, 50 lakh. Now understand how it is going to impact the profit in case of potential. This is number of 12% convertible debenture of rupees 100 is 1 lakh. So how many debenture we have? 1 lakh. Each debenture will be converted into 10 equity shares. So if they converted, suppose if they converted 1 lakh debenture we have, and if they convert it, they will get 10 equity shares. So 1 multiplied by 10. So that 1 lakh debenture is going to be converted to 10 lakh equity shares. So I will add 10 lakh number of shares. Interest expense for the current year is 12 lakh. So I don't have to pay the interest. So my profit will also increase 12 lakh. But I have to pay the tax. They say 30%. So minus 30% because my profit will go down when I will pay the tax. Because when you don't pay the interest, profit will increase. But tax is also increased. So my profit will go down. So 1 crore is the profit. We don't have to pay the interest. So plus 12 lakhs minus 3 lakhs 60,000. Divided by this coming 60 lakhs. That is coming how much? 1.806. Is it correct or not? 1.81. Correct. So here it is decreasing that here from 2 to 1.806. It's a diluted. We have to mention 2 and 1.06. How simple it is. Okay, 7 marks. Okay. Now the last concept that I want to discuss with you. There is a concept of share option on diluted EPS. What does it mean that? Okay. First of all, share option is a employee stock option plan, we also call them. Understand the concept that. Let me take a figure from here only. So it will be easy for you to understand that. Okay. Now what happened now? If I say that now, what is this share option? I am offering that here. I'm offering that here share option that here at a lower price that here. Okay. So what happened? Here it says that now, for example, net profit for the share option outstanding weighted average number of shares that here, average fair value of 1 equity share, average weighted number. Okay, now understand this. I am giving the option that here now. To that here, I am giving you how many shares I am giving you? I am giving you 2 lakh shares. How many shares I am giving you? 2 lakh that here. Now please understand. I will go to that theory, don't worry. But if I say that here now, let me go to repeat this only. I am issuing that now here is a 2 lakh shares. Okay. So if I want to issue 2 lakh shares to you, I am offering to that here employees that here, okay, take it at a lower price. Okay. Employee stock option plan at a lower price. Suppose I am offering you that here now, just at rupees, let's say that I am offering you at rupees 20. So 2 lakh shares I am giving you at rupees 20. So 2 lakh multiplied by 20, that is coming how much? Rupees 40 lakh. So when I say that here, I'm to receive from you, you are my employee. Example, this is an example. Okay, you are my existing employee. I say that here, I'm giving you at a lower price. Do the job with me for the next 5 years. After that, I give you the offer of the shares, 2 lakh shares at the rate of rupees 20. So by issuing this 20 lakh, by issuing these 2 lakh shares, that here now, how much I'm receiving from you? I'm receiving from you 40 lakh rupees. Okay. But the market price is something else. The market price is rupees 25. If I issue these 20 lakh shares, I will get more amount. Or if how much amount I raised from you? I raised from you is a 40 lakh rupees. So when I say I raised from you 40 lakh, if I want to raise this same 40 lakh rupees in the market, I don't have to issue 2 lakh shares. In market, I don't have to issue 2 lakh shares because in the market, the value of the share is not 20, it's rupees 25. So by issuing a 2 lakh share of rupees 20 each, I raise how much share? 40 lakh rupees. But to raise the same amount of 40 lakhs from the market, how many number of shares I have to issue? So if I divide it by the fair value is suppose 25. This is a fair value. Okay. And this is the option price, exercise price, the price at which I have given to you. Okay. Now 40 lakh that I raised from my the existing, I give you the shares and I take the amount from me, and total amount is 40 lakh. If these 40 lakh I want to raise from the market, that is 25 is the rate, I just have to issue 1,60,000 shares. So what does it mean that now I have issued you 2 lakh shares, but to raise the same amount in the market, I have to issue only 1,60,000 shares. So I have issued that here now additional 40,000 shares. You understand this point? I raised from you 40 lakhs. But to raise the same amount from the market, I have to issue just 1,60,000 shares. So I have issued additional 40,000 shares. So what happened? This AS20 say that here, when in case of a share option that here on diluted EPS, they say, we just have to consider the difference here. We just have to, these difference, instead of the 1,40,000, I have issued the, instead of 1,40,000, 1,60,000, we issue 2 lakh. So the difference is coming of 40,000 shares that here, that we have to consider when we calculate a diluted EPS. In denominator we have to add back, numerator nothing, because we additional number of shares that we issued now, from instead of 160,000 we issued how much, 2 lakh. The additional 40,000 shares that we've issued, only that we have to consider, because 1,60,000, the logic is that for 1,60,000 you receive the amount, so they say it's okay. But for the 40,000 shares, you don't, basically you issue additional 40,000 shares. So numerator is going to increase, but for that you are not going to receive any amount that year. So if numerator is going to increase, so your EPS will go down. EPS will go down. So they say consider it that year. Okay, they adopt the conservatism approach that year. EPS is going to down, that because of that they consider it, but not the 160,000. They say additional number of shares that we have issued. Okay, that we have to consider. Now let's take an example on it. This is also favorite ICA question. Now they say here, net profit for the year 2012, 24 lakh, weighted average number of shares for the 2012 is 10 lakh. So if I calculate the basic EPS, how much is the profit? 24 lakh. How much weighted average number of shares? 10 lakh shares. So it will come EPS coming 2.4. Not diluted EPS. Okay. How much is the profit? 24 lakh. No change it. But here, how much number of shares that we have? 10 lakhs. Plus, now this calculation is important. Plus, now they say average fair value of the equity share during the year is 25. Now we are offering them under the option 2 lakh shares, and we are offering them at rupees 20. So we are offering, if I talk about how many number of shares, we are offering 2 lakhs. But that here, if this 2 lakh, but if I say these 2 lakh shares, how much amount I will raise that? We are offering at rupees 20. Divided by, that will come 40 lakh. If I issue in the market, I will get 25 per share. So 2 lakh number of shares, multiply by 20, divided by 25. So only by issuing 1,60,000 shares, I will raise the amount. So here how much will come? 40,000 shares that is now. The additional shares we have issued 40,000. This we have to consider 40,000. So how much it will come? 24 lakh divided by 10 lakh 40,000. That is coming 2.30. You can see that here. 3031, 2.307. So 2.31. This is how to calculate it. So it should be considered. That's it. Because they say for 160, they say you are going to receive the amount, but additionally we have increased this much. So my denominator is going to increase the number of shares. For that we are not going to receive the amount, so it will reduce the EPS. So that's why they say consider this only. Okay. So there's one more thing, but no need to go for the, if there are multiple potential equity shares, there's some way of doing it. ICA has not considered the question on it. They have just given the theory. But in my EO batch or regular batch, we solve a question on it, but not consider for the purpose of revision that year. Okay. Now, that they are going to ask you question from these whatever we have covered here. Okay, this is all about accounting standard 20, that is EPS. I know that so many students messaging me regarding this the AS revision lecture. Don't worry. Now next I will upload an AS 22, 23, 24, all AS or AS 21 consolidated financial statement already uploaded that. Okay, that is for today. Take care all of you. Bye bye.